started. So cool. Quick agenda for today. So a quick introduction about ourselves, then we'll get into the heart of it. We'll talk about the market overview. So I usually attend this conference called O Capital Multifamily Conference. And this conference happens once a year. And usually it is, we go there physically to network, to learn about the newest things. And that's usually in person. But this is the first year that they had it live virtually. And within the first hour of doing so, you had 450 people trying to join 100 people limit Zoom room. So definitely some growing pains there, but we were able to, finally get a much larger room, and turned out to be a very good conference, right? So lots of interesting things going on, especially with the elections, and especially with COVID and all the different impacts. So there were panels on basically the multifamily brokers, on what the current transactions look like. There were lenders, there were other deal sponsors that talk about how their deals are doing. There's a special panel called the rocking chair. So these are basically people who have been doing multifamily asset management for over 25 years. And so they're a little bit older, a little wiser, and they own anywhere from like 2,000 to 5,000 doors. So lots of experience, huge portfolio. So they're also able to see much wider than what's happening across an entire United States for the apartments. Okay, we'll go into the current loan changes, what kind of pricing we're seeing now, and then we will talk about how has multifamily operations been the past 6 months through COVID. And finally, we'll wrap up with what does the future look like. Okay, cool. So standard disclaimers, we're not brokers, we're not agents. We're not giving out any legal advice. This is for education only. Please don't sue us. So we're not soliciting, we're not selling anything. If we do ever find a deal, this will only be offered to people that is on our email list. And so it's not going to be broadcast to the public at all. So if you want to be on the list to be notified when we have found a suitable deal next, please make sure you join the mailing list. And you can just email us to let us know, and we'll add you onto the list. Okay. So like I said, this meetup purely for education. I love sharing my experience with people. So please welcome to invite more people to join our meetup, and also like us so we can reach out to more people. Okay. Cool. So who we are? We are Link Multifamily. So we're basically a large group of multifamily investors. So far, so I've started this out through passive investing in many apartment syndications. Eventually, we started acquiring deals for ourselves. So far, we acquired about $35 million worth of apartments in Dallas. So consisting about 350 units, right? So syndications is basically a way for, like none of us can buy a $10 million, $20 million apartment on our own. So what we do is we combine our money together, and we're able to take down much larger projects and enjoy all the benefits there that way, right? So syndication is a pool of people going out to buy large assets. And you can see this, basically this is how, the entire world runs, right? All these Class A buildings that you see going up, those are syndications, right? You see a new hotel being constructed, well, a syndication of investors put in the money to build that, right? Basically, all large projects are funded through a group of investors, right? There could be big investors, small investors, but usually there's no way one person or one company can take on the entire thing. So a little about me. So I'm a software engineer by trade. I still enjoy working on software engineering right now. So I was fortunate enough to be in 2 IPOs. One is Aruba Wireless. The second one was actually before the dot-com, during the dot-com days, Alteon, which was later acquired by Nortel. So I've been investing in real estate for quite a while, both in the United States and out of the United States. I had a few investments in China, investing in housing there. So I started out doing a lot of passive investments. So I invested in about 10 multifamily deals, about 3,000 units. And I also invest in many different types of investments, such as self-storage, new construction, blind funds, etc. So my partner in crime is Dave Lin. Dave is also like a little mayor. He has properties here in the Bay Area. He also has quite a presence in Austin. So he has also bought a few quadplexes and duplexes in Austin. And he also has other investments in China as well. So together, we also have other people that we partner with. One of my best pals, who's a fellow syndicator, their name is Boris and Oshi. We are partnering together to take down large projects, right? So beginning of the year, we were in the process of acquiring a 550 unit portfolio, and we were all the way to best and final, getting ready to acquire the property. Finally have something to offer you guys, but then COVID hits, right? And we decided to walk away from the deal because it's just too much risk for our investors. Okay. So yeah, these were just a couple of the deals that we bought. 218 unit Class B, 143 unit Class C. So both of them in Texas. And yeah, we raised about $6 million for these acquisitions. Okay, so I'm not going to go over this too much, but basically benefits, there are many, many benefits of investing in apartments. Main thing is you can scale up and be much more efficient in terms of your size. And it does extremely well in a downturn like this, right? During COVID, apartment collections have been very stable and almost very little impact. Okay, so my favorite is probably all the significant tax breaks. Thanks to Trump, while he was in office, he made a lot of great tax exemptions for people who invest in real estate. Things like, on the profit that you make from real estate, 20% of that won't be taxed, right? If you do it through flow-through entities such as an LLC. There are other things like your appreciation is going to be 15%, long-term capital gain. There is things like your cash flow for the first few years is because of depreciation, you're going to get your cash flow first few years tax-free. So yeah, and last but not least, very, very attractive financing. It is incredibly cheap. I'll give you guys a better idea later on and it'll be covered. But right now, you can borrow $20 to $50 million at 2.8%, right? It's pretty ridiculous. And you can borrow up to 80% of the asset value. So extremely attractive. I mean, just think about locking in for 2.8 for like 12 years or whatever. It's just crazy. So the way that we invest in these apartments is we basically purchase a property that's not that doesn't have the full potential realized. So we would go in there, we would do what we call a light renovation. So light renovation basically involves painting the cabinets to be white, doing a simple backsplash, changing the countertop, and changing the flooring, right? So all these doesn't cost that much money. It's about $3,000 to do like a 900 square feet unit. And that's because economy of scale, right? When we change out these appliances, we're getting them at a fraction of a cost. 3 major appliances, fridge, stove, dishwasher together, it's about 600 to 650. Okay. And then the granite, it's like about $100 a piece, right? It's super, super cheap when you start buying in bulk. Okay. Okay. So now for the interesting part, market overview. So when we talk about this, I like it to be interactive. If you have questions about what we're talking about, feel free to jump in. So right now, as you can see, we had historically high unemployment due to COVID, right? It is such that, we have definitely recovered from our high of like 15 to, as high as 18%. So now it's down to around 7.9%. So the unemployment seems to imply that, we're back to a pretty good place, right? However, that doesn't represent the full picture. In fact, because of the stimulus funds, because the way that it was rewarding people for not working. I mean, back then, when we had the CARES Act, if you were on unemployment, you were getting $600 extra per week. So if you were unemployed, you were getting an extra $2,400 a month on top of your unemployment benefits. So for a lot of people, they just kind of stopped looking for work, right? They got so used to just enjoying these government subsidies that it didn't really pay to go look for work. Okay. So, we're definitely doing better. If you look at the latest economic data, we actually did extremely well. We're actually recovering quite well. But it's not the full picture, right? So we always want to weigh our risk looking into the next year. So the second part is, even though we've been doing pretty good, we're coming up on winter. And as we can see in the European countries, they have started a second round of shutdowns due to COVID, right? So France is having a shutdown, Germany is having a shutdown. And, if the COVID cases doesn't get that much better, I don't think we'll see another round of shutdowns in the US. I mean, the people in the US just doesn't really go for it that well, but there will definitely be more restrictions and much more care. So yeah, okay. So what we really like to see coming for the next year is really a second round of the stimulus money. So this was supposed to have happened and distributed out to people, but because of the presidential elections, it was basically put on hold. But now that the presidential election is over, I do kind of expect that a second round of stimulus money will now be sent out. It's just a matter of how big the stimulus checks will be, right? So as you can see, because of these factors, right, looking into our very murky crystal ball for the next half a year to a year, there's still a lot of factors in play, right? Especially with how COVID will continue to affect the economy, and which can be really offset by another round of stimulus, okay? Because we saw that when the first stimulus was given out right at the beginning of COVID, it had a great ability to stabilize the economy. So we're definitely looking forward to see how that will do. But don't bet against the U.S. economy. I would say time and time again, if you look through all the cycles that we've had since, even just taking from, year 2000 after the dot-com bust, right? After the Lehman Brothers of 08, 09, right? The U.S. economy is just so resistant. It pretty much comes back stronger every single time. Okay, so definitely interesting to watch. So a lot of people have been asking me, how are the apartment transactions been trending during this time? So as I briefly mentioned before, in January is usually the busiest time for multifamily transactions. There's a big national multifamily conference, and during which the brokers all prepare the big deals. All the deals they prepare to present in that mid-January conference, right? So this year was no exception. A lot of deals happened, in the beginning of the year, but they all came to a screeching halt by the time that it was April, right? So because of COVID, it was really hard to get financing, to find the funding to close the deals, and especially the price may not make sense when you factor in the risk. So majority of the deals really just stopped. People walked away from the deals, and some hard money were lost, but in general, I would say out of 30, 40 deals, only about 5 reached the finish line, but it took them about 4 months to close for those deals. Okay. So now in September, so we basically had 0 transactions through the months from March to August. Okay. It was just a desert. Nothing was being offered. But all of a sudden, because the apartments have been doing so well for the past 6 months during COVID, everybody was collecting about 95 to 100% of the rent before COVID. So the balance sheet looks really good. So everybody was ready. Okay, so in September, we saw an explosion of deals. I mean, everyone and their mom was selling their apartment. Okay. So there was over 30 deals in Dallas alone, just being offered, and they were all trying to call for offers in about middle of October. So what was happening is there's a certain amount of uncertainty, and there were all these people trying to get rid of apartments before the presidential election. Okay, so they wanted to a point where, okay, I got it I sold it, I got it under contract. The person has hard money, they have tied up maybe $200,000, $300,000 of guaranteed earnest money that they'll buy this apartment. Then they can feel safer about no matter what happens out of the presidential election, they don't have to worry about that uncertainty, right? So tons and tons of people were selling their deals. So some good, some not so good. Some people were trying to rush it, like they were trying to sell the deals that they only held for like a year or two. So you had to assume their loan, and that's not as attractive nowadays, right? With an interest rate so low, everybody wants a new loan. Okay, but what we found is the price has not changed. Okay, so some people were hoping that, hey, maybe we'll see a bloodbath. We can pick up some apartments cheap. That didn't materialize because apartment collections were so good. It was so stable that there was no reason to lower the price, right? So 2020 price is about the same as the 2019 price. In fact, it gotten a little bit more expensive. Okay, which is really surprising. You want to look for deals? No, it's actually worse. So that's why I say you actually didn't find any distressed sellers. You actually found many distressed buyers. Okay, it's very interesting. So, so why are there so many distressed buyers? Well, there's all these funds or syndications that have raised a lot of money, right? You have these syndications or these funds that had just raised $2 billion, okay, and they need something to buy, right? And then there was nothing to buy for the past 6 months. The fund may have started at the beginning of the year. Typically, a lot of these blind funds, they start at the beginning of the year. there's a blind fund for every year, and then they would try to acquire X number of properties during the year, right? And that would be their fund. But there was basically nothing to buy, right? There was nothing to buy for the first half of the year. They have all these investor capital sitting there. They got to buy something, even if it means very low return. They got to buy something with this money. Otherwise, investors' money are really just losing value to inflation, right? So there were a lot of outrageous numbers being thrown around for these deals. These fund managers didn't care about the price. They just needed to buy something, okay? The second half of it comes from people like us, right? So we probably, still have a good chunk of change inside our bank account, right? What is it making in our bank account? 0.5%, and with a treasury rate, with a CD rate, it's really not doing anything, right? So, if somebody tells you that, hey, we're still able to get 5%, 6% cash on cash in Dallas, right? People would rather go do that, okay, rather than have the money sit in the bank. So there's a lot of people with money trying to chase deal, trying to get a better return than what they can in the bank. Okay, so in terms of private equity alone, there's like a $200 billion worth ready to buy, right? So you can imagine, the prices are not coming down. Okay, so in my opinion, we looked at a lot of deals, and for me, I think most important is not to lose investors' money, right? So I'll only go for a deal if it makes sense. And it's not just the price alone. We also need to factor in the risk that we are looking at in the current market. It's COVID, right? You have another year of COVID considerations. You have to price that in to your offering price. If you just blindly buy an apartment for the sake of buying an apartment, if next year doesn't work out that well, you're gonna be in a lot of hurt, right? You may not be able to get the rent increase that you were hoping to get, right? So more than any time, you want to be conservative in what do you think, how much growth do you think you can see? So let's talk about the elephant in the room, which is, so it looks like chances are, if nothing really changes at Nevada, most likely we will see a Biden presidency, right? There's good points and there's bad points. So let's kind of go over that. What does a Biden presidency mean for us, right? So one good thing about a Biden presidency is him and Pelosi will definitely get to work on issuing a second round of stimulus checks. And these checks, this new stimulus package will be way bigger than what the Republicans want, but they are going to shove that through. So, probably you can expect a stimulus check about the same order as the initial one, and which will help tremendously in the tenant's ability to pay for rents. That'll go far. And Democratic priority also dictates that they want to add a lot more funding for social services, rental assistance, government programs such as Section 8. He talked about increasing Section 8 funding by $12 billion, so their way of solving the problem is to try to put more money, more rental assistance into people's pockets, and hopefully they pay for that, right? The bad part about a more democratic leaning policy is they are going to probably push very strong anti-eviction policies, okay, which is really bad for us landlords, right? So in the bill that Pelosi was introducing before before the election, she actually was calling for a 12-month national eviction ban, right? So that thing didn't go through, but now if Biden wins, that becomes a very real reality, right? So a 12-month eviction ban would have a huge impact on apartments' ability to collect, right? If the tenants know that, you can't collect from me for 12 months, not only are you gonna be hurting for money, it also sets up a bad frame of mind for residents, right? So they're, even after that 1 year's over, they're spoiled now. They're going to be trying to find ways to get out of paying rent. So that's a real risk there. So something like, if you look at LA, in LA, basically, you cannot evict anybody until 2012. And then if you look at San Francisco, you basically will have a hard time evicting people. And their definition is as long as they're impacted by COVID. So that could be any time, right? That there's no end date to that. So it's pretty scary in terms of like the eviction memorandums that they might have, right? You have places like Oregon, okay, or Washington saying that if you raise rent on people, you need to pay for their costs to move to a cheaper place, okay? So a lot of these things, especially on the West Coast, right? So we believe that Texas and other places will still be landlord friendly, and that, aside from the eviction memorandums, most of these controls are going to be on the state level. So at least we'll be in states that won't be impacted as much, right? So another thing that they're actually suggesting is mandatory Section 8 placement. So which means that in current climate, if somebody brings you a Section 8, you can say that no, my apartment complex, we don't accept Section 8, right? Or we reached our desired percentage for Section 8. But one thing that they were talking about, one thing that Biden was proposing was you have to accept them. Okay, so if somebody brings you a Section 8 voucher, okay, I mean, it's government guaranteed and everything, you have to consider them. Okay, you can't say that, nope, I don't do Section 8. Everybody has to consider those applications. Okay, so, but it's not such a terrible thing nowadays, because if they do increase the funding for Section 8, it broadens the kind of people that will qualify for it. Okay, so when we take Section 8, we take ones where the residents still pay for a portion. We find that those residents who still pay, where the Section 8 probably pays like 80% and they're responsible for 20%, those people tend to take care of the apartment much better because they have some skin in the game. They put money into the rent every month, right? So, so they don't want to lose that. So that's the kind of Section 8 people that we would consider. Okay. The other thing is with Democratic leanings, they have talked about whether or not to do away with a 1031 exchange. That's mostly beneficial for real estate investors, but not so much for the everyday people. And they might undo some of the capital gain tax rates that Trump has pushed for. I don't think the Democrats have an appetite to redo that whole tax rewrite that we had in 2017. That's just way too much, but they're very likely to let a lot of these benefits, these capital gain benefits, expire when they come, when it's time. So these are things that we should consider as we're investing, right? So, any questions? Cool. Okay, I'll keep going. All right. So jobless claims, right? This is the initial jobless claims. It was being touted like, look, the numbers are much better, right? We had a peak in March, of 6 to 7 million initial jobless claims. I mean, looking at the chart, the gray areas are the past recessions. And you can tell how absurd, how not normal this time around is, right? You go from like about 500,000 to 6, 7 million surge. And it's gonna have a long lasting impact, okay? That it'll probably take many years to fully recover from this, right? So you can see that, yes, the initial jobless claim drops, but on the next picture, then you kind of put that into the context. Okay, so as you can see, yes, it has trended down, right, for the initial claims, but as you can see, it is still 3 to 4 times higher than what was normal before, and that is week after week after week after week, right? So this impact to the employment base will take some time to flatten out, okay, and for us to fully recover. So in terms of but the effects of this economy is different depending on what industry you look at, right? So of course we know that. So this is how many people have lost their jobs in terms of the sectors, right? So as we know, hospitality, right, and leisure, such as hotels, vacation spots, those dropped off tremendously. Okay. And second of all, education. Basically, these are the the non-circular education and services, right? It went way down as well. Okay. So mining, oil and gas extraction, with people driving a lot less, there's a lot less demand for gas, right? So overall consumption is down. Plus OPEC just kind of broke their pact, and and everybody started producing like crazy, right? So that really drove the oil price, the crude oil price down. So a lot of jobs were lost there as well because there's just not as much demand. So retail has done bad. But so what has been strong, right? What has been strong? Basically, white collar jobs has continued to do extremely well, right? So finance, professional services, okay, tech jobs have weathered this extremely well. And a lot of it has to do with the fact that they're able to also work from home, thereby saving the company a lot of operational cost with them not having to come to the office. Okay. So as an example, I work in startups. This is like the 4th startup I've worked at. And our startup decided that we were actually very efficient working from home. We probably don't need an office. So we broke our lease and decided that, nope, we are not going to look for a new office space until next March, next spring, right? And in the meantime, everybody seems to be super productive at home. In fact, we're probably too productive at home because we're probably working like our entire waking hours. We're just on Slack. We are just, we're always available now. There's no separation between work and home anymore. So if anything, we work more than before. So by not having an office, startups can save substantial amount of money. Okay. So other parts is what we notice is retail. In terms of retail, large anchor tenant retail, such as for Safeway, Kroger, these grocery stores that are still pure necessities, those do very well, right? But for multi-tenants, such as malls, such as large strip malls, those don't do as well, right? Because usually during this downturn, you notice that it's just the supermarkets that remain extremely busy. Okay. And here's kind of looking at the fund rate, the Fed rate, right? So this is what Fed sets for the short-term lending rates. So you'll see that this is basically the Fed's primary tool to combat a recession or to combat and to also keep inflation in check, right? So as you can see, the Fed, this is around the dot-com time, right? So the Fed starts reacting to an economy that's worsening by lowering the fund rate, right? So lower, 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 okay. And we have some periods of making sure that the recovery is stable, and then started raising the interest rate back up. Okay. And then we hit the Lehman and subprime crisis over here in 08, 09. And then you can see that they start lowering the interest rate slowly, slowly, slowly. And because it was a protracted downturn, they lowered it almost to zero. Right? In the end, they lowered almost to zero. So if you take a look, they kept it at near zero for almost 6 years. Okay, for almost 6 years before they started to raise it again. Okay, they were able to do this because during this period, even though they kept the interest rate at near zero, there was very little inflation. Inflation was much lower than they were expecting. Okay, but what you can see is the Fed's, the one thing that they did right this time is they took actions immediately. Okay, so as soon as the recession started, when it started looking bad, they immediately brought the rate. They immediately brought the rate to zero right away. They didn't even wait. Okay, and that has definitely helped. So they're getting better and better at this, right? So they're able to foresee. But what this means is, most likely, especially with the employment so impacted, we're probably going to see the interest rate to be extremely low to a near zero level for an extended period of time, 5 to 7 years. Okay, so I would expect mortgage rates, etc., to also be correlated and remain low for long time. Okay, so that means for a long time, your money that you're sitting as cash equivalents are not going to make much money in the bank, unfortunately. So can you keep this up? Can you keep doing this, right? Because when you keep rates so low, we're bound to see inflation, right? Right? No. Actually, we have not seen any sign of inflation. Remember, the US was printing money, so in order to fix the economy, we just printed ourselves a few billion trillion dollars, right? This is what we call quantitative easing. When you do things like that, the expectation is we're gonna see a huge jump in inflation. It just didn't happen. So inflation remain very controlled, very low, below people's expectations, even after all these money printing. So, looking forward, are we going to continue? Are we going to see an inflation as a result of these low interest rate? Chances are not likely. There's two possibilities, right? Every time, you see the pattern now, right? Every time there's a recession, the Fed is going to try to keep dropping the rate, keep dropping the rate, keep dropping the rate every single time. You can only use this medicine so many times. Eventually, this medicine is no longer effective, right? And they start running out of tools. At that point, then you might see some real inflation. The other possibility is, if there is such a large demand for goods and not enough supplies, you might see real inflation. But right now, that's not a very likely scenario. Any questions before I move on to the next one? Okay. So I think we'll definitely continue to see some inflation, and Feds have indicated that they're very comfortable with letting inflation rise because it's been below projection for so long. So even if inflation goes kind of high, just catching up to what they were expecting before anyway. So they're not that afraid about inflation. So expect interest rate to be low. So what happens when interest rate becomes low, right? You know, you look at the 10-year treasury, it is low, okay? And what we're comparing here is basically the cap rate. Cap rate, you can think of it as how much return do you expect to get out of your commercial asset, right? So, you know, a very, very simplistic way to think about it is if you buy an asset at 5.5 cap, you can kind of expect to get 5.5 return on your money. 5.5% return on your money. Okay, so for retail, for investors, you know, they're basically looking at, hey, if I keep my money in the bank, it's earning this super low interest rate. If I go and invest in something large, the difference is pretty big, right? So this is why there's so much capital flooding to buy apartments right now. Okay, because leaving money in the bank doesn't make sense when you can get this kind of return by investing in other assets, right? In other years, when this is much closer, you know, you have 5% return in your bank, and then buying a larger asset, commercial asset, nets you maybe 6-7%. The gap is so close that you'll just leave in the bank and, you know, just don't take the risk, right? So, but at times when the spread is this large, people are now looking for a better place to put their money. Okay. So this is basically, you know, collection trend. It's not even throughout the sector. So we kind of want to take a look at how different sectors are doing, right? So offices, basically these are medical offices, right? So things like, you know, the small emergency rooms, the pet hospitals, you know, the single unit emergency care, that type of places, right? They do extremely well. Those businesses do well no matter what kind of market it is, right? People still need to be seen for the sickness, and they're hugely profitable, and they always pay on time. So those are always really good. Multifamily has been really good. I would say it's about 95% collections through the nation. And in the portfolio that I hold, I see the same thing. We're collecting 95 to 100% of pre-COVID times. In fact, September was, you know, I was collecting 5% over pre-COVID time. So it's been extremely stable, right? Because in the end, you know, people need a place to live, and they will always try to pay for rent first because they really don't want to get kicked out into the street during this COVID time. Okay. So office collections have been good, which is a surprise. Okay, a lot of people see the little the vacant offices because everybody's working from home, all that kind of stuff. So why is the office collection so good? Well, if you look at a multifamily, you know, if you look at maybe Class C, you know, or Class C or low end of the spectrum, okay, you know, after they pay off the rent, they may only have $400 in their pocket, okay, to go the rest of the month with, right? So they're kind of tight. However, for companies, after they have paid for their rent, for the office rent, they still have a lot of cash, okay? And these are 5-year leases, right? So they're able to continue to pay. They have the ability to continue to pay, right? So office collection has been really good. You do see the trend right now is the people who own the offices are trying to sublease it out, right? Because they don't need the entire office space. So even, you know, like if you look at Google or Facebook or some other companies, they probably will let a good portion of their workers continue to work from home. So even after everything comes back, I would expect a quarter or maybe a third of the people will be eligible to just always work from home. and only come into the office once in a while for meetings, right? So the demand for office space will go down, especially in large cities, right? But right now, it's still holding up. They still have the money to pay for the rent and not break the lease. Okay. Industrial is another really strong suit. So industrial, such as manufacturing, such as warehouse, those continue to do really well, especially warehouse, right? So you see everything kind of going remote now. So Amazon deliveries, Walmart deliveries, all these kind of stuff need places to hold these goods more and more and more. So industrial continues to be a good sector, right? And then over here, you have the single tenant retail, multi-tenant retail. We kind of talked about that. Okay. Another thing to talk about here is delinquency. Okay, so how do these different sectors compare in terms of delinquency? Well, the ones I'm familiar with is multifamily, which is apartments, right? And you have your hotels, and then you have your retail, right? So everybody knows hotels are dying. They're terrible right now. So they're about, I would say 40% of the current hotels are delinquent. Okay. And then, so there's different levels of delinquency. You're delinquent, or you are actually placed on a watch list, okay, which says you're about to be delinquent. We know you're about to be delinquent, and we're watching you very closely. So that watch list is actually at 70%, which is very, very high. So these loans will probably go bad at any minute. They just can't hang on for this extended amount of time. So if you're adventurous, maybe you should look into picking up a hotel. But a hotel business is a very, very different business than multifamily. Unless you have experience managing something like it, I wouldn't do it. We're trying to learn as much as we can about the hotel business. Maybe if there's a deal, it's something that we will expand into. But even us, we're treading very carefully. You're buying something that's gonna be very distressed. Normal hotel occupancy is about 70%, okay? And most hotel deals assume that they can be at break even with 60% occupancy. Right now, the occupancy is at 10%. Okay, so how are you gonna manage that? So if you buy a hotel right now, you have to expect to lose money for a year before things starts coming around. But you can probably buy it at really, really discounts. Right. So yeah, and then if the market's already coming back, you probably won't get that good of a deal. So to get a good deal on hotels right now, you have to take that risk. So okay, moving on. So the retail delinquency is probably right now for retail sector, it's around 20% right now that is delinquent. So much better than hotels, but as you know, they're suffering, right? So what is the delinquency rate for multifamily? 1%. Of all the loans that Fannie Mae and Freddie Mac had lent out, only 1% is delinquent. And their normal delinquency rate when times are good is 0.5%, right? So there's basically been no impact to multifamily during the downturn. Going to see. I think somebody's not muted. Okay. All right, so now come to the little bit more interesting part. So what is the current rental market looking like? So somebody made a really good analogy. The current rental market is like hitting from the rough. Okay. So it's like hitting from the rough. You have rough patches, okay, and you have to try to fight your way out of it, right? So, but it's a long journey. You might have rough sections. You might have time where it's very smooth sailing, right? So if I reflect back to our COVID times, um, beginning of the year when COVID first hit, we as a partnership, we have a pretty large partnership. We have about 6, 7 sponsors. We all sat down and then we discussed our strategies, right? So at that time, we were talking with James Ng, and so our strategy at that time was, what would happen if our rent income dropped by 40%? Okay, and everybody did a stress analysis. What happens if my apartment rent or occupancy goes all the way down to 60%? How much money do we have and how long can we hang on? Okay, so at that time, the stress test that I did on my properties, we basically determined that if we lose 40% income, we have enough money to last another year. Okay, to complete last another 12 months before we have to ask the bank for some kind of assistance. So the rest of the properties, all came in at about 9 months to, about 13 months. We as a group are very well capitalized. We keep very large reserves. So when we buy a deal, we usually raise enough money so that we have three to $400,000 in reserves, specifically for these downturns, to make sure we can survive these downturns. So we're in pretty good shape, right? Even if it's 40%. But as we gone through April to August, we saw that, hey, our collection actually wasn't that bad. We were prepared for a 40% drop. We only saw about 5% drop, okay, which is very observable. We were actually still making money. We were making money on almost every single one of our apartments, right? So it was pretty good. So when you get into a nasty situation like that, don't panic, okay? Just like hitting it from the rough part of the golf course, assess your current situation, see what is the current situation, how bad is it, and what are the issues gonna be, right? And then you go and find the best tool that you have for the job, right? And get yourself out of it, right? So along the way, there's definitely going to be rough spots. There's going to be smooth spots as well, right? It's not all bad, just like what we saw for COVID. But I would say one of the best assets that we have are all the partners that we, all the other asset managers that we have in our group, and as well as from my days passively investing with other groups, I know a lot of people. So I gotten to know a lot of asset managers, and we all share tips. So we all talk about like, hey, what can we do? We cannot evict this person. Hey, where can we find extra help because we're running low on maintenance staff, right? So together, as a larger syndication, groups of groups, we have a lot more resource to address these issues. So we did a number of things. Number one was moving everything online. Okay, so because during the COVID time, nobody was coming to the office, right? So what we did is we really beefed up our online presence. And then we also did the 3D Matterport, which is, it allows you to walk through the property and look around as if you were in the property, right? So they can do they can do virtual walkthroughs without having to take the risk of COVID, right? We also had another system where the prospective tenants can schedule an appointment with us, and we will leave, once they come, we will leave a key outside for them, and they could take it and go check out the location, right? They can go check out the apartment that they're gonna rent without having our staff needing to get involved, right? So, and we also moved a lot of the rent payments online. We encourage people to do that. we had raffle drawings to encourage people to pay online to so that to minimize contact, and we increase our marketing in many different ways. So one of the things is we found some, we advertise through Google. Google, there's actually ways you can advertise for free by updating your status. There's a cheap service called Zumper that people use for doing rental lookups. So we got a lot of leads through Zumper, and Zumper is cheap. If you do a listing on apartments.com, it costs around $700 a month. Okay, pretty expensive. And then with Zumper, they're capped. They basically get paid on a per lead basis, and that money will not exceed $200, for example. So we got a lot of leads through Zumper, and wasn't expensive, right? So Craigslist, Facebook groups, so we heavily targeted the Facebook Latino groups. They're really, Latinos have been a great tenant profile for us. So and we are office managers. We always have somebody who speaks Spanish, so they would go to the Spanish speaking groups and advertise our apartments, and we get a lot of leads that way as well. So yeah. Any questions? Okay, moving on. So collections, you can kind of see how the overall market is doing. So 2019, we're kind of averaging about 95%, sometimes higher. 2020, only a little bit lower, maybe 2 to 3 points lower. Okay, so even through the same months, it's pretty good. If you told me at the beginning of COVID that we're going to be collecting 90, 92, 93%, I would say that would not even have crossed my mind. We were preparing for 40% drop, right? So, but it's been really good. So yeah, percent of rent being made, similar, we're pretty stable at about 95%. And if you take a look, even within Dallas, right, different areas have different tenant profile and different, yeah. So if you can look, Dallas did pretty good, okay, 93%, 96%. Austin is pretty strong in terms of collections as well, okay. Houston is probably the one that dropped the most, partly because, for that market, the oil and gas dependencies and the seasonal jobs, you're going to see a little bit more impact there, right? San Antonio was kicking ass last year, but yeah, their tenant profile is not as diverse. So okay, and this is something that we track a lot. So basically, what percent of rent do you collect on the first week? Okay, and then what percent of rent that you collect on the second week? So this is pretty important because it gives you an overall indication of how your month will go. Most capable people will pay the first week, and some people who rely paycheck to paycheck would want to pay on the 14th. Okay, so they get paid beginning of the month, getting paid in middle of the month. So most people who are delinquent will try to pay by the 14th. Okay, and then the people who, and these are the seriously delinquent people after that. Okay, but usually, yeah, about 75% of the people will pay within the first week. Okay. Going on, so this is basically, jobless claims. How much has it been, right? Job count. So you'll see that Austin has recovered really quickly. It is, tech focused, so that's to be expected. And then Dallas Fort Worth is doing pretty good. Houston is a little slow, and you'll see that being reflected, right, in the collections. San Antonio, not too bad either, right? So So this is actually pretty interesting. This is basically rent growth year over year compared to last year, right? So you'll see that Austin actually dropped a lot in terms of the asking rent. This is because Austin is considered a higher tier in terms of class size, right? So Austin has a ton of new buildings. They have a lot of class A's, brand new, super expensive, and people don't really want to live in super expensive places right now, right? They're looking for more affordable places. So from the top of a market, Austin is gonna see a larger drop because a lot of the new builds that are finishing, the Class A's are just finishing, they're having trouble leasing up all their units. So they're offering 2 months, sometimes 3 months of free rent, okay, just to get somebody to sign the lease and come in. So that definitely puts a downward pressure in terms of like the rent increase, right? So lost about 5% rent year over year. Houston down about 3%. San Antonio down about 1%. And Fort Worth, Dallas Fort Worth is, actually didn't do too bad, less than 1%, right? So we had to keep this in mind. Okay, so if you see people buying an apartment and then they're projecting that, hey, we're gonna grow 3% in 2021, and then we're gonna grow 4% in 2022. That's just not gonna happen, right? That's not what the current market is. But you might actually see that because these people overpaid for the apartments that they bought. They have to manipulate the numbers to make the growth look much better to justify their purchase price, right? So if you see people being very optimistic about their rent growth projection, you want to be careful, okay? Because it's going to be a challenge to hit some of their projections, looking at the current data. So this is basically a comparison of what is the demand compared to some of the areas, right? So you'll see that Dallas-Fort Worth, the amount of people that's moving to Dallas is really, really good. Atlanta has been really strong as well. Phoenix, Denver, Charlotte, all did pretty good. But there's a ton of people moving to Arizona, to Phoenix, Arizona, really fast growing. Dallas-Fort Worth, I mean, you're getting 100,000 people a year. There's a huge migration to Dallas-Fort Worth. Kind of reason why it's turning blue. There's so many Californians and New York people escaping to go to Dallas and Austin, etc. And that's why they're lamenting the fact that it's voting more and more blue, and I believe Austin has a Democratic mayor as well. So kind of surprising. So as you can see, New York is suffering big time, right? Same thing with San Francisco. If we just look at the tech companies, right? If Facebook, if Uber, Lyft, Google, if they're all gonna let their employees work from home at least until like middle of next year, then why do people want to pay $4,000 or $5,000 in rent just to be close to the company? They don't, right? They could move to Modesto, they can move to Tracy, they can move to Sacramento even, right? Get some much half-price rents. And then if they need to still come into the office 2 to 3 times a month, they could do that. That's not bad, right? But they're saving so much money and they can work remotely most of the time. So I personally know that places like Mountain View, Sunnyvale, San Francisco are really suffering in terms of like the apartment rent, occupancy wise. I think San Francisco is looking at about 30% vacancy right now, and just sign of the times. And I don't think it's going to completely come back either for these large cities, because remote working is going to be part of our life moving forward. Okay, stop real quick. Anybody have any questions? I think I saw a chat real quick. Where's my chat box? So is it LA 2022? Yes, yeah. LA it practically means that you can't really evict anybody from LA until 2022. Yeah, the slides and recording will be available to the attendees. So I'll be setting this out. Okay. You guys have no questions, feel free to type questions into the chat. I'll answer as we go along. And yeah. So, okay, I'm gonna keep moving on that. So talking a little bit more about what we went through, in our apartments since COVID hit, right? So as soon as COVID hit, there was a CARES Act. CARES Act basically, in addition to all the social benefits to unemployed and to everybody, basically free check, helicopter money. What they also instituted eviction ban. So basically, anybody who got their loan from Fannie Mae or Freddie Mac, which is majority of the multifamily out there, you can't evict people, right? So you can't really evict people until that period ended. So during this time, we couldn't evict anybody, but people were still paying because they got the stimulus money, and we, our office people were good friends with with a mailman. Okay, so the mailman would actually come by and then tell the office, hey, I just dropped off a batch of stimulus checks. Okay, and these are the people that got it. So our leasing lady would actually call them up, say, hey, how's it going? Hey, now's a good time to kind of pay for it. I think you got paid, right? So they would chase people based on that. And so that's why we got pretty good collections. But obviously there's some people that's going to take advantage of the situation. Not too bad. I think out of like 140, 200 people unit apartments, you saw maybe 2 to 3 people that truly wanted to take advantage of the system. Everybody else was making best effort to pay the money, right? Because if they have an eviction on their record, it makes it hard for them to find a new apartment. It also makes it hard for them to buy a house, right? So people don't really want that on their record. So when CARES Act provision expired at end of July, we immediately started filing eviction notices. So normally the eviction notice is a 3-day notice, right? You're warning them 3 days before I'm going to start evicting them, right? To go to court. But now they require a 30-day notice of eviction. But we did that, and we filed evictions on anybody who owed more than $300, right? So, and that was extremely effective. So when they realized that they are in danger of getting kicked out, they started paying. Okay, so in just 1 month, we got $10,000 worth of back pay that people were owing on delinquent balances. I mean, 10,000, that's pretty huge. So you definitely need eviction as a deterrent to convince people that it is still their responsibility to pay for the rent, right? So so we're kind of celebrating. We're happy that, hey, finally, the tool that we have to ensure people pay, we finally have that under our control again. But that didn't last very long. So as we were evicting people at the beginning of September, Trump instructed the CDC to now give the eviction memorandum, right? So you cannot evict people until end of the month, end of the year. But then which is another, big shock to us, right? So we studied this this memorandum declaration very, very closely. And we didn't have too many people turning that in. So one thing is when you had to basically declare that I was impacted by COVID. I really don't have any outside income. And I really tried my best to look for government assistance. Right? Now, if you lie, potentially you could be, you would be convicted for a small crime, right? We're pretty sure that wasn't going to be enforced, but every person that came and talked about this, we reminded them that, hey, you are under oath that this is true, and you might be in legal trouble if you don't tell the truth, right? So I think out of 15 people we were evicting, about three of them turned in the eviction, turned in the CDC declaration saying that they're impacted and then they can't be evicted, right? But we're not just gonna let them do that, right? So so what you can do is you can actually challenge these CDC declarations, okay? The bad thing is, when we go to eviction court, the courthouse, the judge was actually handing out these declarations and telling people that if you just say yes, if you just sign, they can't evict you, okay? In fact, there were actually pro bono free lawyers sitting on the side helping tenants. It's like, hey, this is how you fill it out, all that kind of stuff. But we were very thorough with our paperwork on what they didn't pay, all that kind of stuff. So out of the 15, we actually ended up evicting 10, successfully winning the 10 evictions. And then the 3 people that actually said the declaration, we challenged 2 of them. Okay. We know one for sure was actually got sick from the COVID, so we didn't want to burden her. But there was one lady that was really, really bad that hasn't paid since March, and we really wanted her out. So for that one, we challenged, and we provided proof that, see, no attempts at payments, okay? No attempts at getting federal or government help, right? And we won that declaration, and we were able to kick her out. That was a really, really happy day for us. But you want to do this not because you're being mean to the tenants, or you're being mean to or all these things, right? We have done everything we can to try to help them. So there's a lot of government assistance programs. So every time when we're sending out the monthly billings, we actually send them, say, hey, here, this is how you can apply for housing. This is how you can apply for help from the county, okay? And we actually started filling out the forms for them. We started filling out forms for them and just giving it to them and said, please, all you have to do is just sign it, send it in, and then the government, will give you free money for your rent, right? But sometimes you don't understand the people, So out of all the people we offered it to, I would only say like 3 or 4 people got off their ass to actually go and fill out the rest of the paperwork and provided some kind of employment verification and then to get the free money. Okay. So it's challenging. Even if you do everything for them, they're still so lazy and they just, I don't get it. Yeah, but if they just sign on a dotted line, turn it in, and that's like $3,000 for you, right? Wouldn't you want that? Yeah. People are weird. That's why they live in apartments and not in houses. So yeah, so we were able to go. So additional housing restriction is that if housing or the county is providing financial assistance to your tenant, then you're not allowed to evict them. Okay, that's one of the trade-offs. Okay, so there's going to be people that have made some payments, not the whole amount, and they stop paying, but you can't really get rid of them because they actually made an attempt, right? So how do you get them out? Well, so one strategy we started doing is, this is only on tenants that we really don't want on the property, right? So you can do what's called taking back the unit through repossession, through possession, okay? You're not trying to evict them due to non-payment, okay? That's a really hard route to do. So you can start writing warnings for them, okay? So you get on them like white on rice, right? So if they walk their dog and forgot to pick up the poop, okay, that's one warning, okay? If they don't keep their balcony very clean, okay, well, that's one warning, okay? Loud noises at night, one warning. Okay. All you need is 3 warnings, and then you can actually take the unit through possession. You don't go through the whole eviction process. You just prove that, hey, see, 3 warnings, 3 lease violations, and 3 lease violations is enough for me to take back the unit. So we only had to do it this one lady, but you know, we have it at our disposal, right? So what you do is, we've been handing out like COVID care packages. We've been trying to provide as much resource for people. We actually gave out a lot of the cleaning kits. We want the community to be good, to be safe, right? But for the people that is taking advantage of us, then there's no room for it. Okay, so yeah, so there are ways you can still get rid of people, even though there's still eviction bans that's going on right now. Okay, let me just take a look at the chat. Are single-family rental trends similar to multifamily rentals? I'll cover that, but the single-family rentals, it really differs on the area, okay? But generally, the single-family rentals have done fairly okay as well. The single-family housing pricing has also been doing pretty good, okay? So if we look at single-family housing, mortgage was really cheap 2 years ago, okay? And that allowed a lot of people to refinance their property, have more purchasing power, and so the housing price has been going up, right? And then we kind of hit a lull and in price increase. But even with COVID, because the refinance rate has dropped so low, it has allowed the housing price, there's still a large demand for housing. There's simply not enough housing being built in the US. Okay, so this lack of demand and coupled with a low interest rate is once again causing housing prices to rise, okay, or at least not fall very much. I think a lot of places actually increased, and that correspondingly helps the kind of rent that you can charge for apartments, right? From what I've seen, the single family rentals has been, the rental prices have been pretty steady, but it's actually been kind of hard to evict people, especially in California. Okay, so for larger apartments, we're part of this group. We have our dedicated eviction lawyers. We have the whole 9 yards. So it makes sense for us to bear the cost of hiring some of these legal counsel in order to execute certain evictions. But for single family owners, what I find is a lot of times they're like, man, I kind of know the tenant, yeah. So the single family tenants have a higher tendency of being delinquent for a long time because the owners usually don't push them as hard. Yeah. So second question, on average, how much are you leveraged by percentage? So we can borrow up to 80%, okay? As long as the income can justify it, right? So I would say the last few properties we bought, we borrowed 78%, 76%, based on the latest quotes I've seen, it's yeah, the latest quotes were all around like about 76% as well, right? So you're able to borrow a lot of money for very, very cheap. So, and you can lock it in for a pretty long time. So if you if you can borrow $40 million at 2.8%, that's like free money. You can do so much with that. It's basically free money. Okay. So what do you think in terms of investments in Class A versus Class B and C during this time in Texas? Okay, good question. So what was it that was said? So when there's blood on the street, that's when you should go buying. But make sure you have experience before you do so, because it's very risky. But usually that's when the most money can be made. Okay. So like I mentioned about hotel, right? Everybody can understand hotel. Hotel is a disaster right now, right? Hotel is a disaster right now. You can probably go pick up cheap hotels, but do you know how to run it? You know, do you want to take on that risk, right? Same thing can be said about Class A. Okay, so what you notice is every time there's a downturn, people move to more affordable places to live. That's going to be Class B apartments. That's going to be Class C apartments. Okay, nobody's going to go rent these super expensive high rises in the cities, right? The Class A type of things, right? So Class A typically sit at maybe 80, 20% vacancy, or maybe 25% vacancy during this time, right? Which means their earnings suck, which means that you could potentially pick up Class A's for a pretty good price, right? That's a real possibility. However, right now, because of the large funds that I'm talking about, we're not seeing that much drop of Class A, okay? But I think it will come. So right now, the Class A prices and the Class B prices are getting closer and closer, okay? So it becomes a point where it almost makes sense for you to go buy a Class A property if the price is so close, right? So right now in Dallas, Class B is trading at about $120,000 a door, okay? Class A is probably trading at about $170, $180 a door. Okay. If it gets much closer than that, I would pay $20,000, $30,000 extra a door and get an asset that's less than 10 years old, right? I mean, there's a lot less maintenance. There's a lot less things to worry about, right? The tenant base tends to be better. But one thing you have to remember is you can pick up a Class A properties are very different than Class B and C, right? Class B and C, we enjoy the cash flow and we can improve the interior and increase rent, right? So we can do force appreciation that way. There's things that you can improve and charge more. In Class A, not really. There's not really anything that for you to improve anymore. Okay, so you buy Class A mainly for long-term cash flow. Okay, so within my group, there's actually some people who's interested in that. So let's say you're about to retire, you're 65 years old, you're 70 years old. You don't care about you probably don't care as much about like I want to double my money, right? That's probably not a priority for you. You just want to not work and still have income. So then for that, investing in Class A makes sense, right? There's in Class A nothing will really break, okay? So the expense is pretty stable. So you buy a Class A, you invest in Class A, and then you just take your 5-6% cash flow every year, and just drip, and then that's enough for you to survive on your retirement for, right? So a lot of people do that. We are definitely open to that. So if we see something that's worthwhile, Class A, that's worth going for, that's an asset class we will probably consider going for and offer to our investors because I think it makes sense. Okay. Yeah, so single family rental community and has done very well. Yeah, yeah. I think what's suffering is the expensive housing, right? The expensive San Francisco, all that kind of stuff. People are starting to scale down, so smaller single family or apartments that's not that expensive will do very well during COVID because whether a single family, whether it's apartment, people need a place to live. Right. Okay. Are these special corporate loan rates? No, not really. Basically, any multifamily can apply for them, and they have different programs, right? So any loan. So Freddie Mac specializes in what's called Freddie Mac SBL, which is small business loans, right? So those are loans from $1 to $5 million. Okay. Also pretty good rates there. Not as good as the larger properties, but also really good rates for the 5 year. The kind that we go for is the Fannie Mae. The Fannie Mae basically goes from 5-6 million to I've seen $80 million loans, right? And usually the larger the loan is, the cheaper the rate is. So I'm telling you the current rate is about 2.8, okay, 2.6 if you go for a 10-year lock. They go down lower than that for much, much larger properties. So yeah. Okay. Does this still make sense to invest in near college towns in Texas? That touches on the topic of education. Okay, so how is the education right now? So this year the student housing has been a little bit impacted, right? Because not all the students have returned to campus, especially if they have remote distance learning. Okay, so it doesn't really make sense for students to pay for a year of apartments when school is probably not going to start until the second semester, right? It's probably not going to be in person until next year. So what we're seeing is um, for student housing, it was around a 90 lease out rate. Okay. Normally, by the time school starts, you have about 98% lease out rate already. This year, it's a little bit lower, about 90%. And then we're seeing more demand for 6-month leases. People are trying to start signing a 6-month lease come January, right? So I do believe that they will start to recover, but you probably cannot pick it up cheap until beginning of next year, right? So school is one of those things where if there's a big downturn and people lose their jobs, the young people, if they don't have a better job, they tend to go back to school. Okay, so sometimes school do good, but this is not really the same kind of downturn that we had last time in 2008, 2009. So because of the social distancing, it really throws it kind of out of whack. Yeah. Good questions. Keep them coming. So let me talk a little bit about the loans, right? So as we mentioned, we get our loans directly from Fannie Mae, Freddie Mac. So we don't really have to go through a broker. In fact, when we buy apartments, we don't even have a buyer agent. It's always you deal directly with a property broker and directly with a loan broker. So we get our loan quotes directly from Fannie Mae, and Fannie Mae is like the Cadillac of all the loans. You can't get it much cheaper than that. Okay, so but they're being very cautious right now. Okay, so when you go and buy in a property, they want you to pay upfront 12 months of mortgage, property tax, and insurance. Okay, as well as repair reserves. This prepaid amount is put away in a lockbox. You're not allowed to touch it. Okay, that is basically Fannie Mae's guarantee. Okay, that's their safety net. So after 1 year, they will look at one more quarter of performance. Okay, if after 1 year, you have another quarter where you're meeting 1.25 DSCR, which means you have 1.25 times the income of whatever the loan obligation is. So if your loan obligation is $100,000, they want to make sure you're making at least $125,000 net operating income to cover that. Okay. So they want to make sure you're profitable 1.25 years after you buy the property. Okay. So this is already improvement from before, because before they wanted to lock up everything. Okay. They wanted to lock up your insurance. They wanted to lock up like all kinds of stuff. Okay. And that was breaking deals. Basically, people had to raise $2 million extra for this reserve. And that really lowers your overall return. So they reduce it to 12 months, and they say it's just, yeah, mortgage and P&I, so, but that's still quite a bit of money, right? So on $20 million deal, you probably need another $1.4 million just to satisfy the reserve, okay? So this would lower the overall 5-year return by 14%, because the way that we make money in apartment is, let's say we invest $3 million. Everybody put in 50 grand or 100 grand each, right? And we come up with $3 million to buy a property. Our goal is to increase the value by another 3 million, and thereby doubling everybody's money, right? So we put in 3 million, we appreciate another 3 million through improvements, and now we have doubled our money, right? But if we're now using 4.4 million to get another $3 million increase, you see how that lowers the return? So the more money you have in the deal, the more diluted the overall returns become, right? So the way that we account for it is, we basically, when we go and purchase a property, we would discount it by about 2.6% on the purchase price, which kind of makes up for this drop in overall return. Okay, so Fannie Mae is still requiring this. Okay, they're able, and they're not likely to drop it. Okay, because if you look at your other loan choices like CMBS or like small banks, when I say small banks, I'm talking about Wells Fargo, Chase, Bank of America. They're not small, but they're very small compared to Fannie Mae and Freddie Mac, who do about $160 billion in multifamily loans each year, right? What I'm saying, so what I'm saying is, because if you go to a small bank, the loan that they give you is going to be full recourse. Okay, whereas Fannie and Freddie gives you non-recourse. So I'm not sure if you guys are familiar with the difference, but in a full recourse loan, if the value of your property drops below the loan amount, then the sponsors are responsible for paying that difference. Okay, so just think about 08, 09, right? All these people try and short sell their property. You buy a $10 million property, you have an $8 million loan. After some disaster, your apartment is only worth $6 million, right? And your loan is $8 million. Guess what? In a recourse loan, the sponsors are responsible for that $2 million. They need to pay $2 million to the bank, right? Which really sucks. Nobody wants that kind of loan. So Fannie Mae does non-recourse. So you have to be very well qualified in order to get a Fannie Mae loan. But looking around, they're the cheapest, right? They're the absolute cheapest. Even if you get a floating rate now, it's about 2.6%. So there's no reason for them to drop this requirement. There's no competition. So they're going to keep this. They'll probably keep this requirement around for another half year or a year. So yeah. Okay. So that just needs to be underwritten into the deal and realize that, okay, the returns will be somewhat impacted. So, you can kind of overcome this by structuring your syndication deal a little bit differently, right? So imagine if you had to raise $1.4 million extra, that will dilute everybody's return, right? But what if you raise that $1.4 million as a guaranteed note, which doesn't share in the profit of the apartment? Okay, all of a sudden then, that could be an option, right? So basically you will have one class of investors whose whose money is there to fund this 1.4 million. Okay, and they're promised maybe like a 5% return on their money. Okay, and it's guaranteed because it's in the lockbox, right? So after 1 year, they'll get paid 5% fixed on their investment. Okay, and after 1 year, they get their money back plus 5%. Perfect. And you were able to handle this $1.4 million raise without impacting your overall return for the rest of your investors. Okay, because this first group of people taking a fixed return doesn't get a share of profit, whereas the other people who raise the normal amount gets a share of the profit, and you can continue. Yeah, so your return will continue to look good. So right now there's some creative deal structuring that to get around this issue, which makes sense. And yeah. Okay, so looking ahead, what's interesting? Well, what's actually interesting is the property tax. So you have to understand that all the states, all the counties around the nation have lost a lot of money. Okay, they lost sales tax income, they lost personal income tax, and they also lost out on all the vacations, all the people traveling, all the food that people go when they go vacationing, right? So all the counties, all the states in the country are hurting for money, and they are going to try to get it back from property tax. So definitely expect to get a higher property tax bill in the future, okay? Because they're fighting tooth and nail on these property taxes in order to get some government funds back, okay? So with the Democrats taking over, there's a chance that there will be an eviction memorandum, okay? So that's something that we'll continue to monitor, but we deal with it as it comes, right? So also court rulings. So as I mentioned, right now judges very much favor the tenants, and if you decide to and if they apply for housing or government assistance, you won't be able to evict them because they're getting government help. In terms of the rates, right? So even though I talk about like there's a 12-month escrow, all that kind of stuff, it's historic low rates. I mean, I think this is like some of the lowest rates in over 100 years. Okay, 2.8%. That's just ridiculous. So a lot of people are still opting to buy, opting to lock in this rate, because if I can get it at 2.8%, a few years down the road, somebody wants to buy my property, chances are the interest rate is probably going to be higher than this, and all of a sudden my interest rate will look extremely attractive, right? And finally, apparently it was so important I named it twice, but yeah, housing price remains pretty strong. Okay, so because housing prices remain strong, that means apartment prices or in the surrounding area will not drop much at all. Right? They kind of go hand in hand as well. Okay, cool. That's about it from me. I would love to answer any questions that you guys have. So one question from our room. Are you guys refinancing your properties? So that's a very good question. So the typical Fannie Mae loan does not allow or has a prepayment penalty. Okay, so basically when you buy a Fannie Mae, when you get a Fannie Mae loan, they at, let's say 3%, okay, 3%. They turn around and then they sell this note to other investors who are then promised 3% return a year for 10 years, 12 years, whatever, right? Now, if you pay off your loan early, all of a sudden, those people don't get the money that they were promised. Then what you are now responsible for is to pay that difference, okay? So that's kind of the prepayment penalty that you have to do. You have to make those bondholders whole, right? So for Fannie Mae loans, we are not we are not refinancing a property, because if we do a refinance, it would incur a prepayment penalty. So how big is this prepayment penalty? Well, on one of the apartments that's pretty close to us, they were selling 180 units for 18 million, so about 100 a door. Okay, that's because they have a prepayment penalty. So on an $18 million property, the prepayment penalty was $4 million. So you can take over their loan, which is at about 5%, and you get to buy at 18 million. Or you pay the prepayment penalty so that you can get a brand new loan. And then that means you had to buy the property for 22 million. Okay, so it's quite expensive. And so it's a step down basis, right? So it's really expensive in the beginning. Every year it goes down a little bit, kind of like your AT&T phone prepayment penalty. It just goes down a little bit every year. Yeah, until 10 years, 12 years. So it's good if you plan to hold on to a property for a long time. It's also good when interest rate is so low now, you actually want to lock in a long-term rate and hold it for a while. But if you want to get, buy and then sell your property in like 3 years, then you don't want a loan like this that has this prepayment penalty. You actually want one that, charges you maybe just a 1% penalty for paying off early. Okay. Okay, let's go through a lot of questions. What is the best way to connect with me? So, well, you're already on the great place by being on the meetup. So, you feel free to email us. You can email me on Meetup. You can also email me directly, and then I can make myself available for like a 15-20 minute chat. I love to get to know people. Maybe you guys are looking at your own deals. You want me to act as a second set of eyes. I mean, I looked at so many deals. And I think I can definitely help out people. So yeah, just email or send me a Meetup message. Okay. So another question, my understanding is investor or commercial loan rates are much higher. How are you able to keep your rates so close to residential? Okay. So if you're getting rate quotes from your local bank, they're going to be expensive, right? They are going to be expensive. So I'm getting like a 2.8 rate from Fannie Mae, but a local bank is probably quoting somewhere close to 3.6 to 4%. Okay, that's why Fannie Mae is the Cadillac of loans, right? They're super cheap, but Fannie Mae doesn't lend that rate out to just any property or any group. Okay, so there's a chicken and egg problem with Fannie Mae. Okay, so Fannie Mae, in order for you to get a Fannie Mae loan, you must have Fannie Mae experience. Huh? Interesting. Yeah. So you're gonna ask, like, well, how the hell do I do that? Well, the way I did it is I partnered on my acquisition. I partnered with somebody who already actually that wasn't the way I did it. But what you can do is you can partner if you don't have experience. You partner with somebody who have experience. If you don't, if you don't have Fannie Mae experience, then get on a loan with somebody who has Fannie Mae experience. They will qualify for the loan, and you get to put your name as part of that loan. And now you have Fannie Mae experience, right? The other way to do it that I did was, you know, one of the requirement is when you're getting a Fannie Mae loan, let's say you get a loan for $8 million, then the combined net worth of all the sponsors of the deal, basically the leads for the deal, the active sponsor net worth must be equal to the loan amount. So if you're borrowing an $8 million loan, all your active partners added together must have a net worth of at least $8 million. Okay. Sometimes people are a little short. Sometimes people, are very, very short. What they'll do is then they'll bring in a high net worth individual with a very high, in order to fill that gap, right? And that's called a key principal, or what we call KP. Okay. So on one of the deals that I was investing in, I joined in as a KP for the deal. So using my net worth, I became one of the guarantors for the loan, and through that process, I qualified for Fannie Mae experience because my name is on the Fannie Mae loan. So the reason why Fannie Mae is willing to loan this low is because, as you can see, the risk is really low, right? They're able to, it's 1% delinquency. 1% delinquency in multifamily while everything else is dying, okay? So same thing in 08, 09, when they were losing their ass on their residential loan, the multifamily loan continued to make a lot of money for them. So Fannie Mae knows that multifamily is safe. It pays even in a downturn, so that's why they're willing to let you borrow up to 80% at such a low rate. Okay. Whereas the banks, local banks, local banks, you're usually using local banks for smaller deals, maybe like 25 units, 50 units. Those are usually inexperienced multifamily operators that are just starting out. And those are people with not as much money. And those smaller properties aren't as efficient as larger properties. So they would impose higher rates to cover the risk. Okay. Next one. Do you do master lease agreements options? We don't. That's not something I do. Yeah. To invest with me, to invest with us, what kind of investment amounts? So typically for deals that we do, it's around 50 grand to 100 grand. Most syndication deals are about this size, anywhere from 50K to 100K, right? If it is a small deal and there's a lot of people interested, then the sponsor may just go like, oh, okay, I'll just do 100K to make it simpler. But predominantly the deals I see out there are about 50 to 75K. Yeah, and yeah, also a lot of 100Ks. Okay. I am gonna unmute everybody, and in case you guys, how do I unmute everybody? Okay, I don't know how to unmute, but feel free to ask me questions in the chat, or you can send me a note on how to unmute everybody. Let's see. Okay, well, you guys can unmute yourself. So, okay. One question, with all the capital that is moving around looking for investment, what is your competitive edge? How do I compete against them? Okay. So with all the money that's moving around, the key really comes down to your relationship. Okay, so there's two things that the brokers pretty much decide who wins the deal. Okay, and for them, um, the group's ability to close on time is extremely important. Okay, so they need to know, are you guys experienced? Have you guys bought a property this size before? Do you guys have an investment group that will definitely want to have enough funds to actually buy this, right? So for example, if I go out and then I look at a $60 million deal, okay, the guy's going to be very curious. Are you sure you can raise, $15 million to close this deal, right? So he'll want to know you, okay? So multifamily space is very personal, it's a relationship game. And a lot of times, I say this a lot, but they sell it to the person that golfed with them the previous day. And it's a club kind of thing. But once you're in, you're good, and you just have to maintain relationship with them. So that's what I do all the time. I call them for no reason, just to just to chat. So that's our advantage, and with this advantage, and my partners have also, so Ken and Win, they had about 12 apartments already. And then Boris and Oshi, they probably have about 7 or 8 properties. So when broker decides who to sell the property to, they're also looking to see how many properties does your group own, because he wants a shot at selling those properties that you own, okay, so that he can make more money, right? So when, one time I did run into something like this, okay? So we were just buying a small apartment, and then in the end, the guy with 12 apartments won over a guy with 10 apartments, okay? Because the broker thinks that I can do more deal with this guy in the future. So he picked him, okay? But because of our relationship, so far we haven't had to overpay. Almost pretty much all of our deals, we were not the top bidder. We won because of our relationship, and because they know we close. So the last 2 deals, we closed in 45 days, and there was no problem with the transaction. Everything went extremely smooth. We knew what we were doing. We got the funds right away, and they like that. So they want to sell to people like that. Okay. So second question, assuming all Biden's agenda comes true, what class of properties do you see getting hit the worst? So I would say Class C will get hit the worst. The reason being, the Class A and Class B properties have people with better jobs, okay? Have people with better savings. And they care, and they do have plans to buy homes in the future. As a result, they want to make sure that they don't have an eviction on their record. Whereas a lot of tenants in Class C, they're basically a lifetime renter, okay? And they live, a lot of them live paycheck to paycheck, and they don't care as much about whether or not I have a bad credit rating or whatever. If I have a eviction on my record, maybe I'll just go live with my mom for a year, and then I'll go look for an apartment myself again in the future, right? So so in terms of like eviction, Biden might impose, I see Class C having some difficulty, but it's not any worse than what we already gone through, right? It'll just be an extension. I mean, we already went through 6 months of eviction ban. We're going through another 4 months of eviction ban until end of a year, right? So we're already in it. We're already handling it. Of course, we rather not have to deal with it. Okay. What do you think about using CARES Act 401k funds in a QRP type account? So I'm not totally familiar with a QRP account, to be honest. What I am very familiar with is using your IRA account to invest in syndication deals. So a lot of us have rollover IRA or traditional IRA, right? We like to switch companies, and you tend to roll over your 401k into IRA, right? So with that funds, with all your IRA retirement funds, you can actually convert that into what's called a self-directed IRA. And then with a self-directed IRA, you can invest in all kinds of syndication deals. You can invest in multifamily syndication deals. You can become an angel investor in startups. You can invest a lot more things than just stocks. You can still invest in stocks. It just opens up your window to a lot more different options. So I personally do that. I have multiple investments that I have done using my retirement account in syndications, apartment syndications. And for the most part, the money that you make is tax deferred, right? So awesome. So if you have any questions about like how to use your retirement funds to invest with, let me know. Yeah, because I can refer you to the guy that did it for me, and it's working good. Is it worthwhile to refi or do a second mortgage to get equity out of a property? So yes, absolutely. In fact, one of the deal I'm invested in did exactly that. So we bought the apartment, renovated it, increased the value and NOI so much that we were able to take out a supplemental loan. Okay, so most Fannie Mae loans come with 2 supplementals. Okay, so instead of refinancing, you're really just getting another loan on top of it. Okay, so you're able to take out a supplemental loan, and we had so much equity that we increased. Fannie Mae gave us enough equity where we used that to pay the investors back. So out of the money that we invested in about a year and a half, we got about 65% of our money back already. So I only had 35% of the money in there, still making the original full return. So that worked out really well. But if you're planning to sell the property, then maybe you don't want to do a refinance, right? I mean, you don't want to take on a supplemental loan. You want to actually just sell the property. But if the interest rate is low, then yeah, by all means, go for it, do it, and then just keep getting the cash flow, right? Because you're going to hold on to it a little bit longer. So generally, how long do you hold the property before you sell? Okay, so generally we hold on to the property until we can double everybody's money. And right now that projection is conservatively, we're thinking about it. It's gonna be about a 5 to 6 year hold to double everybody's money. Okay, so if you put in 100 grand, we will be giving 200 grand back, right? That is the goal, and that's a goal we aim for when we try to when we plan on when to sell the property. Now, there could be certain time frames where we might suggest that, hey, market's really, really good now. We probably want to sell now to take advantage of a situation, right? So the active sponsors will make a proposal to the partners. Okay, so the active sponsor will make a proposal saying that, hey guys, I think it's a pretty good time to sell. If we sell now, we will get a pretty good return, right? And then it is up to the entire syndication to vote on whether or not they want to do this. Okay, some people want to keep holding on to it and keep enjoying the cash flow. Some people want to just go ahead and sell it, cash out the money, go buy a boat, go buy a car or something like that, and then invest some of the money back into the deal. So all the partners get a chance to vote, and at least in our structure, the active sponsors don't get any extra say. Okay, it's not like we get 2 votes or something like that. No, everybody has a vote according to how much money they have invested into the deal. So yeah, passive investors definitely get a vote on any liquidation events, right? Including whether or not to refinance. I mean, to get a second loan. Okay. QRP is qualified retirement plan, so is using self-directed IRA. Okay, yeah. So self-directed IRA, there's self-directed IRA, there's self-directed 401k. Both are great ways to invest. Note that the only thing that you cannot invest with is your current company's 401k. You're limited to the investment choices that your company provides. But once you leave a company, those IRA funds, those are the ones that you can use to invest in syndications. Okay. What is my target IRR? Well, it changes from year to year, but right now I'm a very conservative guy. So I because tie into the next question, how many active and passive investors do I have right now? So active investors, our group is 5 people. Okay, so I have 2 people. I have 2 partners in Dallas. They are our boots on the ground that goes and check out the properties, and then we have 2 and 3 people over here, and we share the load of managing the properties. Passively right now we have 42 people who have invested in our deals. But as you can see, the total pool of people that invest together with this meetup, it's a lot more. We have hundreds and hundreds of people on our mailing list. It's just that last time when we were trying to raise the $4 million to buy a property, it got oversubscribed so quickly that I think we were trying to raise 4 and we ended up raising 7 in 3 days. So unfortunately, not everybody could make it in. So we're trying to look for larger properties for everybody. This way, everybody can join in. So because we have a very strong investor group who has known us a long time and know the deals that I have invested with, I don't have to exaggerate with them, right? So I'm pretty honest, and I tell people that, hey, you know what, on this deal, I'm pretty comfortable that we can get 12 to 13% return. Okay, so that's usually my, what I would aim for in the current market. Probably somewhere like 12% return a year. Okay, is my target. Now the same deal, somebody else can take it and then they can be much more aggressive in their rental projections. And then you'll see people normally project 17%, 20% return, right? That's because their investor group is not that strong. So they have to project a much higher number in order to attract people to invest with them. I think we're pretty lucky that we have a pretty group already, and we're easily oversubscribed on any of these deals. So we don't have to exaggerate our numbers in order to have people invest with us, right? I'd rather be honest. I'd rather tell you that I want to set the bar low. I'm pretty sure we can hit this, right? And what I find is most people rather, hear the truth, hear that, yep, okay, 12%, I'm cool with that. I can trust that number, and they would invest. Yeah, I don't have to inflate it to like, we're going to do 18, and then, I'm sure I can do 18. Okay, I'm sure I can do 18, but that really, all the stars have to align. We can't have a COVID. We can't have like, we can't have like a recession or something like that. And I can't make that kind of promise. Yeah. So yeah, 12% IRR, which is, the yearly return when you factor in the opportunity cost. Yeah. So just know that if I'm projecting 12%, I'm pretty comfortable with making that. That's why I would tell you that. Okay. Cool. Any other questions? Feel free to unmute yourself. Okay. Well, guys, thanks for coming. And if you have any, I'll send these slides out. But if you have any questions, feel free to reach out to me. My philosophy is, because I'm a passive investor myself, I always believe that as long as everybody's very well educated, they're able to decide on which deals are good, which deals are bad, right? And hopefully you can see that the way I underwrite things and is conservative, and you'll be interested in investing with me, right? But that's predicated on people know what they should be looking at. Education, education just helps cut through the BS. Okay, thanks. Thanks, everybody. Take care.